Welcome to the Deep Dive. Today we are unpacking one of the most surprising and, honestly, one of the most comforting truths about money.
Which is?
That financial success has very little to do with raw intelligence or, the school you went to or what complex models you can recite. It really has everything to do with how you behave.
Right. That's the core tension our sources really highlight. I mean, finance is taught as a hard science, right? Input the data, run the calculation, get the optimal answer.
Yeah.
But the data suggests that in the real world, it's much more of a soft skill. It's almost entirely governed by psychology, by temperament, and patience.
So our mission today is to dig into this psychology of money. We're going to look at some spectacular financial collapses versus these decades of quiet, unnoticed success.
And distill the lessons, right? The behavioral lessons that are actually useful for your own financial life.
We're setting the stage immediately with this incredible contradiction. We have the story of a janitor who dies a multi-millionaire philanthropist.
And on the other side, a highly educated Harvard MBA executive who goes completely bankrupt. It's almost too perfect a parable.
It really is. And it starts with a guy named Ronald Reed. And he was, the definition of unremarkable. A janitor and a gas station attendant from rural Vermont.
The sources point out he was the first in his family to even graduate high school.
And he did it by hitchhiking to campus for classes. Just amazing.
And he kept up this incredibly low-key lifestyle his entire life. He fixed his own cars, he was sweeping floors at JCPenney.
And lived in the same modest two-bedroom house he bought for $12,000 when he was 38.
His main hobby was chopping firewood. For 50 years, that was his thing.
And yet, when he dies at 92, back in 2014, he makes international news.
Because out of nearly 3 million Americans who died that year, fewer than 4,000 had a net worth over $8 million, and Ronald Reed was one of them.
And with that money, he leaves over $6 million to his local hospital and library.
So what was the secret? It wasn't hidden. He saved what little he could. He invested it consistently in big, stable companies, what we call blue chip stocks.
And then he just waited.
He let compounding work its silent, exponential magic for half a century. It was just pure patience and quiet frugality.
Okay, so hold that image. Now let's pivot to Richard Fuscone.
The polar opposite.
Completely. Harvard-educated Merrill Lynch executive with an MBA, praised for his business acumen. He retires successfully in his 40s.
But the story doesn't end there. Fuscone immediately leverages all that success into this massive lifestyle. He borrows heavily to expand his, 18,000 square foot mansion in Greenwich.
We're talking 11 bathrooms, 2 pools, 7 garages.
And just the maintenance, just to keep the lights on and the lawn mowed, was over $90,000 a month.
But wait a second. How does a Harvard MBA, who literally advises people on wealth, make such a basic, fatal error? He obviously had the intelligence.
He did, but he lacked the behavioral control. When the 2008 financial crisis hits, all that heavy debt and his reliance on illiquid assets, that giant house, it just turned his fortune to dust.
He went bankrupt. The mansion was foreclosed on.
And it sold for a fraction of what he thought it was worth.
The contrast is it's stunning. Reed was patiently humble. He lived below his means. Fuscone was publicly rich, aggressively leveraged, and just collapsed under his own ego.
And that behavioral difference completely overshadowed the enormous gap in their education and their professional status.
And that's the core realization, right? This is almost unique to finance.
Totally. You would never, ever see Ronald Reed outperform a Harvard-trained surgeon in an operating room.
Or design a better skyscraper? No.
But in investing, because it's ruled by long-term behavior rather than, short-term smarts, this kind of thing happens all the time.
Which takes us right to the heart of it. If behavior is so important, why do some people seem so bad at it?
Well, because we have to embrace this core concept. No one is crazy. People's financial choices, even if they look totally reckless to you or me, they make perfect sense based on their own unique personal history.
That's a huge insight. So your personal experiences with money, that tiny sliver of time you've been alive, it's what? 0.0000001% of what's happened in the world.
Right, but it makes up maybe 80% of how you think the financial world actually works.
And what risks you're willing to take.
Exactly. The luck of the draw, when and where you were born, it completely anchors your risk tolerance. Let's look at the stock market.
Okay.
If you were born in 1970, the S&P 500 went up tenfold, adjusted for inflation, during your teens and 20s.
So you think stocks only go up. It's a game.
It imprinted this wildly positive, almost cavalier view of market risk. But if you were born in 1950, your impressionable years were dominated by high inflation, oil crises.
Stagnation.
Right. For you, the stock market went literally nowhere in real terms. It was a scary, unreliable place, two totally different realities.
And you see the same thing with inflation.
Oh, absolutely. If you were an adult in the 1960s, you remember gas lines, you remember prices tripling. Inflation is this visceral, constant threat.
But if you were born after 1990, inflation has been low your entire life. Your brain just doesn't see it as a major risk.
And understanding those different experiences, it helps us make sense of things that seem completely paradoxical.
Like low-income lottery buyers.
The paradox is stark, right? 40% of Americans can't come up with $400 for an emergency.
And yet some of those same people spend hundreds a month on lottery tickets. It seems insane.
Mathematically it is, but we have to look at the emotional rationale.
They aren't just buying a ticket.
They are buying a tangible dream. For someone who's trapped paycheck to paycheck, where saving, say, $5,000 seems like this impossible decade-long slog, the lottery is the only thing that offers a chance at radical change.
It's paying for a chance to get the good stuff that society is constantly showing you because the normal way up feels broken.
And, we should remember that even for those of us who are saving, we are all basically financial newbies.
What do you mean?
Well, modern ideas like the 401k that didn't even exist until 1978. The Roth IRA is barely old enough to drink.
So this whole idea that everyone should be their own personal fund manager is a very new experiment.
A very new experiment. Dogs have been domesticated for 10,000 years. We've only been asking every citizen to manage their own retirement for a few decades. Of course, we're going to fumble it sometimes. We're all new to this game.
Which brings us to the most fundamental question then.
Right.
Why bother? Why go through all the trouble of saving and investing in the first place?
That's the ultimate goal.
And the data suggest the highest form of wealth isn't the flashiest car. It's not the biggest house.
It's control.
It's the ability to wake up every single morning and say, I can do whatever I want today. It's control over your time. Doing what you want, when you want, with who you want.
That control buys you options. It's the ability to take a sick day without that financial panic. It's the flexibility to wait for a good job after a layoff, not just the first one that comes along.
Or the emergency fund that just eliminates the fear of a bad boss. You know you won't be ruined if you stand up for yourself or, just quit.
And the tragedy of modern work, especially for professionals and managers, is that we've lost so much of that time control.
How so?
Back in the 1950s, a factory worker left their tools on the assembly line. The job ended at 5 p.m. Done.
But today, if your job relies on your brain is the tool. The work never really ends.
You're thinking about that presentation while you're making dinner. You wake up at 3 a.m. stressed about a client problem, that perpetual mental engagement. It just kills the feeling of control.
There's a psychological term for this,
Yes.
right? Reactives.
Yeah, reactance. It's this idea that when you lose control over your schedule, even doing something you genuinely love can start to feel oppressive. It feels just like doing something you hate.
And financial flexibility is the firewall. It's the buffer against that loss of control.
Which is why we have to be really clear on the difference between being rich and being wealthy.
Okay, let's use the valet paradox.
Perfect. So, rich is current income. It's easy to spot. The person driving the $100,000 Porsche. Let's call him Roger. Roger is clearly rich.
But the paradox is that the only piece of financial information you actually have about Roger is that he has $100,000 less than he did before he bought the car.
Or he's $100,000 deeper in debt.
Right.
Wealth, on the other hand, is hidden. It's the income you don't spend. It is an option that you haven't taken yet. It's flexibility.
So spending money to show other people how much money you have is quite literally the fastest way to have less money.
Exactly. Ronald Reed, the janitor, was wealthy long before he died. But because his wealth was hidden away in compounding assets, nobody knew.
Okay, moving into our final section, we have to talk about maybe the most important financial skill of all. Survival. Longevity.
Because getting money and keeping it are two totally different skills.
Getting it requires optimism, taking risks.
Keeping it requires humility, it requires fear, frugality, and recognizing the role that luck plays in all of this.
Look at Warren Buffett. We always attribute his fortune to his investing skill, but the simplest fact is the most profound.
He's been a good investor since he was 10 years old.
The key is longevity. The vast majority of his, $130 billion net worth, came after his 65th birthday.
Right when compounding really took off. If he had been forced to retire at 60 because of some emergency or, bad behavior, he would have missed that entire explosion of growth.
The most important book on investing should probably just be called Shut Up and Wait.
But sticking around, waiting, you have to endure something that most people are wired to avoid.
Volatility.
Volatility. Successful investing has a price. But the currency isn't dollars. It's fear, it's doubt, it's uncertainty.
And this is where that crucial distinction between a fee and a fine comes in.
Yes. When the market drops 20%, you have to see that drop as a fee. It's the mandatory admission price you pay to be in the long-term compounding game.
It's not a fine. It's not a punishment for doing something wrong that you could have avoided.
Exactly. When investors see volatility as a fine, they try to avoid paying it. They start doing tactical trading. They sell before a recession they think is coming. They try to time the market.
And almost inevitably, they miss the gains on the other side, and they end up paying double by missing the recovery.
The only real antidote to that kind of crippling fear is building in room for error, what we call a margin of safety.
You have to plan on your plan not going according to plan.
Because your life will be interrupted by surprises, by setbacks, and this is the crucial part, by changes in your own goals and desires.
The sources call this the end of history illusion.
Which is the belief that, yeah, we've changed a lot in the past, but right now, this is who we are, and we won't change that much more in the future.
And we are terrible at predicting how much our values and our goals will shift in 10 or 20 years.
Because your future self is a stranger, you need flexibility. This is why Bill Gates made sure Microsoft always had enough cash in the bank to pay a year's payroll, even with zero income coming in.
And Warren Buffett famously pledged to always run Berkshire with more than enough cash. He said he'd rather sleep well than maximize every last point of profit.
Room for error sounds conservative, but it's actually what allows for endurance. And endurance is what lets you stay in the game long enough for compounding to work.
You have to avoid those single points of failure.
There's this anecdote about a German tank unit in Stalingrad. It was rendered inoperable not by enemy fire, but because field mice got inside the vehicles and ate the electrical insulation.
A risk that no designer ever plans for.
But it happens. You need to save for things you cannot possibly predict. You need to save for the financial equivalent of field mice destroying your electrical grid.
It's all about being financially unbreakable. And that resilience, that's what provides the greatest long-term returns. So, as we wrap this up, let's distill the core lessons for you, the learner.
First one, aim for reasonable over rational. Don't chase some mathematically perfect strategy that's so brittle you can't stick with it when fear hits.
Like Harry Markowitz, the Nobel Prize winner who basically defined modern portfolio theory, his personal portfolio was just 50-50 stocks and bonds.
He did it not to maximize his paper returns, but to minimize his future regret. He was optimizing for sleep. You should too.
Second, focus ruthlessly on your savings rate. Remember Ronald Reed, the gap between your income and your ego matters so much more than your income level or your investment returns.
A high savings rate buys you that ultimate dividend, flexibility and control over your time.
And third, know your game. Write down your time horizon. Write down your goals. If you are a long-term passive investor saving for retirement decades from now.
Do not take your cues or advice or your emotional swings from short-term day traders. You might be on the same field, but you are playing a completely different game.
And finally, a provocative thought to leave you with. The ability to be financially unbreakable will likely generate the biggest returns because it maximizes the one thing you can actually control, your longevity in the market, which allows compounding to do its magic.
So if you accept the end of history illusion, that your goals and desires will fundamentally change over time, how does your current savings rate give you the flexibility to abandon an old plan without regret? And what unexpected future self are you preparing for right now?